Hi, I'm Ron Benegby. I'm the founder and CEO at Uplinq, but more relevant, I'm an immigrant. My family migrated to Canada in the early 70s. We were poor, we had no money. My dad was baking bread at night to put food on our table. And in 1973, he went to a bank, and he asked them for a small business loan, to which the banker told him, Mr. Benegby, you really don't qualify for this loan based on how we lend here at the bank. However, I believe in people, and here's $5,000. My dad took that $5,000 in 1973. He started a small business, and that became the springboard for our family's lives in Canada. And I share that story with you today because at Uplinq, we don't lend money to small business. However, we work with small business lenders to help them say yes a lot more often. In fact, 5 to 15 times more often, while significantly increasing net income. We have repurposed an existing technology that had been a part of over $1.4 trillion in lending origination over the last 15 years into a modern day fintech. Our mission is simple. It's to create financial inclusion and get working capital into the hands of all small business owners and to impact the lives of millions of families around the world. With that being said, I'm going to turn it over to my co-founder, Patrick Riley, to share some more details.
Hello, everyone. It's great to be here. Uplinq makes small business underwriting easy for any lender. We use APIs to interact with those customers. Today, I'm also going to use an underwriting UI so you can better see the power and performance. The data you're going to see is real data. It's one of our clients, a client that we helped grow profits by over 10-fold. That amounted to over $200 million for them annual bottom line. All great lending starts with great data, so let's get in and actually get over and take a look here. We actually pulled data from a wide number of resources, 10,000 in total globally. And you can see we have connectivity into all major core banking platforms. We use that to align scores to the specific use cases in each particular institution we serve. We also have connectivity to loan origination systems and decision systems. We interface with credit bureaus in over 165 countries. And we have rich identity information and interface with all the major rating agencies. In addition to that, we have a rich body of information from permission sources like Acrolis, Plaid, Amazon, QuickBooks and other financials, tax records, appraisal information and valuation information. And if you want to understand any small business well, you need to understand the ecosystem they're in, from the macroeconomics to what's happening on the street corner. So we grab a rich body of information from this broad information that informs us about what's going on in their world. Next, what I'd like to do then is actually show you how we make the decision easy. Just pick an account here. This particular client, once again, is real data. They interface with us via nCino. We pull that information in. If the first big difference we make is data, the second one you can see right here. Rather than giving you a score between, say, 400 and 850 or something that looks like alphabet soup, we actually translate every score we bring into our system into a probability of default because that has ROA meaning, it has pricing meaning, it allows us to directly get to financials. In addition to that, you're going to see the third thing, and that's right here. One of the dirty little secrets in model building is that you're rarely told how well a model will actually work for an individual use case. And so what this score actually is a Gini value. And what that means is this model is explaining 91% of the credit risk variability that's underlying this data set. So we have this neat pre-fitment and pre-screening section that allows us to understand if we cleared through KYC, if we cleared through things like OFAC. With inclusion, we do a very interesting thing. We actually run the regulatory BISG test on every account that we book. So whether it is by regulatory purview, whether it's being driven by internal policy, or whether it's personal mission, we assure that everybody is treated in an inclusive way. If we get back to those risk scores again, you can see that we're not just pulling in our own, Uplinq up here, but we're pulling in any scores that they might have. But you can see immediately they don't agree. 12.6 down to 1.9, so what do I trust? That's where we get to that Gini score. And immediately we can see there's a radical difference in predictability across these scores. And we can also see how they fit various levels of reg compliance. By the way, we're SR 11-7 compliant. I want to get back to that $200 million, though. If we look at the continuum here, what we can see is, it's a pretty geeky thing, I understand, but what we can see is what we call a Lorenz curve. And basically, we can measure credit risk along a continuum and customers booked. This particular portfolio, once again, a real portfolio of ours, has a background charge-off rate of 12%. You can kind of add up those ISO bars here. And so the problem they had was, even using a proprietary model that they paid over $1 million for, to get to an acceptable loss rate, they actually had to say no, something on the tune of 95% of the time. That's a difficult position to be in, and they still ended up with a couple of percent loss rate. With the Uplinq model, which is the blue line, what we're actually able to do is get to a point where we can lend, boom, there you go, about 75% of the people. That's a 15-fold improvement in who we're able to say yes to. And if you're looking at that loss rate, you can see there's over a 3-fold improvement in the credit quality. So there is a 10x improvement. I can't promise we're going to do a 10x improvement or $200 million for you, but we would love to prove what we can do for you. And so thank you very much, everyone.